Look at your screen right now. What you're seeing isn't a glitch in the matrix. It's not some random administrative error or a banking hiccup. It is a highly optimized, legally sanctioned wealth extraction machine. And here's the scary part. It's sitting quietly in the corner of your life, just waiting for your 65th birthday to pounce. Welcome to the masterclass. Today, I'm exposing a financial death spiral that is wiping out middle-class retirements across America while you're busy picking out wallpaper for your retirement home. Most people think retirement in the US is a passive event. You work hard, you save in your 401k, and you coast. But the federal bureaucracy does not reward passivity. It penalizes ignorance. And there is no penalty more relentless than the Medicare Part B enrollment trap. Here's the illusion of safety. You're turning 65. You're still working. You've got great insurance through your company. So you tell yourself, why would I pay the government a monthly premium for Medicare when I already have coverage? That single, logical, innocent thought is exactly what the system is hoping you will think. Because if you miss filing a specific form called the CMS-40B at 65, the government hits you with a lifetime penalty. Let me repeat that. A lifetime penalty. For every year you wait, a 10% penalty is permanently, and I mean forever, added to your monthly premium. But look, a 10% or 30% penalty, that's just the bait. What I'm showing you today is a catastrophic chain reaction, a cascading failure that forces you to liquidate assets, triggers massive IRS tax bombs, and eventually gives the government the legal right to garnish your Social Security. Pay very close attention, because by the end of this video, you'll understand exactly how the bureaucracy crossfires. More importantly, you'll know the exact legal sequence you must follow to bulletproof your wealth. To understand this trap, you need to see it in action. Let's talk about a real-world scenario. Let's call her Sarah. Sarah is sharp. She's a senior consultant at a boutique engineering firm. At 65, she's making six figures, she's got a great group health plan, and life is good. When her 65th birthday hits, she gets that Medicare card for Part A in the mail. It's free, so she keeps it. But she deliberately declines Part B, the medical insurance. Why? Because her HR department, the people she trusts, told her, "You're covered. Don't waste money on Part B yet." So Sarah keeps working. 3 years later, at age 68, she packs up her desk, throws a party, and goes to officially enroll. A few weeks later, she receives a notice of award, but instead of the standard premium, her bill is 30% higher. Sarah is furious. She calls Medicare, and the agent on the phone calmly tells her that her coverage didn't count. Wait, how? She was working, she was paying premiums to her company plan. Here is the cold, hard truth hiding in Title 42 of the Code of Federal Regulations. It's known as the Medicare Secondary Payer Rules. This is the hardest truth about Medicare that HR departments routinely get wrong. Under federal law, if you're 65 or older and you work for a company with 20 or more employees, you're safe. Your employer's plan pays first and Medicare pays second. In that case, you can delay Part B. But Sarah's firm only had 15 employees. Under the MSP rules, if your employer has fewer than 20 employees, Medicare is legally the primary payer. Your employer's insurance, it becomes secondary. This means at age 65, the federal government assumes Medicare is picking up your primary costs. If you don't enroll in Part B, you essentially have zero primary health coverage in the eyes of the law. The IRS and Medicare systems communicated, flagged her company's size, and slammed her with that 30% lifetime penalty. And here's a dark twist. Even if you work for a Fortune 500 giant, what happens if your company goes bankrupt? What if they get acquired and the new HR department purges the old files? If you can't produce a physically signed form from an authorized officer, you're done. The first trap just snapped shut on Sarah. But that was just the beginning of the domino effect, because to pay for these new penalized costs, Sarah is about to make a decision that will wipe out her entire Social Security check. Make sense? We're just getting started. Now, remember what Sarah did at age 70? She was stressed about that 30% penalty, so she did something that seemed completely logical. She sold a small rental property she'd owned for 20 years to build a cash buffer. She paid her taxes and thought she was safe. But here's what your CPA probably won't warn you about until the bill is already in your mailbox. The Social Security Administration doesn't look at your current bank balance to determine your Medicare premiums. They look at your ghost, specifically your financial ghost from 2 years ago. In the industry, we call this the 2-year lag. When Sarah sold that property at 70, her modified adjusted gross income, or MAGI, shot through the roof. The IRS saw that, processed her return, and then 2 years later, they whispered that number into the ear of the Social Security Administration. At age 72, Sarah wakes up and finds out she's been hit with the second trap. IRMAA. IRMAA stands for the Income-Related Monthly Adjustment Amount. But honestly, you should just call it a hidden wealth tax on the middle class. Because of that property sale 2 years ago, Sarah was pushed into the highest IRMAA bracket. Her Medicare Part B premium didn't just stay high because of the penalty, it skyrocketed from about $170 to nearly $600 a month. And her Part D drug plan, that tripled too. But wait, it gets even more sinister. The government doesn't send you a polite invoice for this new fee. They don't ask for your permission. Under federal law, Medicare premiums are automatically snatched directly from your Social Security benefits before that money ever touches your bank account. Suddenly, Sarah's Social Security check, the one she earned over 40 years of grit, is being cannibalized by IRMAA and lifetime penalties. She's now 72, her check has shrunk to almost nothing, and she needs cash to buy groceries and pay property taxes. She's panicking, and when people panic, they make the biggest mistake of their lives. Sarah logs into her brokerage account and orders an $80,000 distribution from her traditional 401k. This is the fatal blow. This is the moment the tax torpedo hits the hull of her ship. By pulling that money out of a pre-tax 401k, she just injected massive ordinary income into her current tax year. Now she triggers IRS Section 86, the taxability of Social Security benefits. Because her income crossed a ridiculously low threshold from the 1980s, 85% of her Social Security benefits are now subject to federal income tax. It's like the government is double dipping into her pockets while she's already down on the ground. And because she didn't withhold enough taxes on that panicked withdrawal, tax season brings another surprise. The IRS hits her with Form 2210, the underpayment of estimated tax penalty. Think about the architecture of this disaster. It wasn't bad luck. It was a perfectly executed sequence. She missed one piece of paper at 65 because of a confusing 20-employee rule. That triggered a penalty. The penalty created a cash squeeze. The squeeze forced an asset sale. The sale triggered IRMAA. IRMAA wiped out her check. The empty check forced a 401k drain. And that drain triggered a massive IRS bill. It's a closed-loop system of wealth extraction. But here's the thing. You don't have to be Sarah. There is a way to stop the dominoes from falling. You just have to know how to use the government's own forms as a shield. Let's talk about the Master Rescue Plan. Make sense? Stop taking notes and listen to me very carefully. I'm about to give you the exact step-by-step Master Rescue Plan. If you or your parents are anywhere between the ages of 60 and 75, this sequence will literally save your financial life. The federal government allows you an out, but you have to use their exact forms in their exact order. Step 1, the Pre-emptive CMS-L564 strike. If you're over 65, still working, and you plan to retire soon, do not wait until your retirement party. 3 months before you leave, you march into HR and you demand they fill out Form CMS-L564. This is the Request for Employment Information form. It is the physical key to your freedom. You watch them sign it in blue ink. You scan it, you copy it, and you put it in a fireproof safe. If your company is ever sold, acquired, or goes belly up, you have the proof to unlock your special enrollment period. Without this signed piece of paper, Medicare will reject your application and slam you with that lifetime penalty we talked about. Furthermore, you must independently verify, right now, exactly how many employees are on your company's payroll. If that number is 19 or fewer, you must enroll in Part B immediately. No excuses, no, but my HR said. You are playing with fire if you don't. Step 2, the SSA-44, life-changing event override. Let's say the damage is already done. You sold a property, you retired, and you just got that dreaded letter from Social Security telling you your premiums are doubling. You have exactly 60 days to appeal this. But don't you dare call them to complain. Bureaucrats do not care about your feelings. They care about forms. You go to the SSA website and download Form SSA-44. This document is a legal weapon. It's called the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form. It allows you to tell the government, yes, my income was high 2 years ago, but my life has changed. But here's where 90% of people fail. You have to fill this out with surgical precision. When you look at the form, it will ask you to identify your life-changing event. Do not get creative. You are looking for two specific boxes: either work stoppage, meaning you retired, or work reduction, meaning you went part-time. You must attach proof: a signed letter from your boss or a severance agreement. If you do this correctly, the SSA is legally obligated to recalculate your premiums based on your current lower income. This single form can save you thousands of dollars in weeks and instantly restore your Social Security check. Step 3, the sequencing rule of asset liquidation. If you need cash to live on, the order in which you take it matters more than the amount. Never take massive capital gains or huge 401k withdrawals without a professional running a Magi projection first. If you need liquidity, you draw from Roth accounts first. Why? Because Roth distributions are invisible to IRMAA. They don't count toward the income limits that trigger the penalties. If you have a permanent life insurance policy, take a loan against it. Again, that money is not taxable and it doesn't trigger the traps. You must build a wall between your need for cash and your tax return. Does that make sense? Because once you see the architecture of the system, you realize you can actually win, but you have to stop playing by their rules and start using their tools. Now, I want to wrap this up with a reality check that most people are too afraid to give you. Listen to me very carefully. The system is not broken. It is functioning exactly as it was engineered to function. The American Retirement Framework, Medicare, Social Security, the IRS, operates on a principle I call default extraction. The system assumes you owe the maximum penalty, the maximum premium, and the maximum tax. And it stays that way until you explicitly, through the correct bureaucratic channels, prove otherwise. It relies on the fact that you are too tired, too overwhelmed, or too trusting of your HR department to read the fine print in Title 42. Think about the math here. They know that a 65-year-old worker at a 15-person company doesn't know the Medicare secondary payer rules. They know that when IRMAA hits, most retirees will panic and drain their pre-tax 401ks. This triggers a massive windfall for the IRS that they didn't even have to work for. It is a closed-loop system of wealth extraction that targets the people who work the hardest. But look, you're not in that group anymore. You've seen behind the curtain. You know the exact form numbers. You know the exact sequence. You see the matrix now. You do not have to be a victim to this machine. You just need to be a technician of the rules. If this video opened your eyes, do me a favor. Hit the like button right now. Seriously, it helps the algorithm push this warning to more people who are about to walk into this trap blindly. Do not keep this information to yourself. Share this video directly with your parents, your friends, or anyone you know who is approaching 65. You could literally be saving them from a lifetime of financial suffocation. One share could be the difference between them enjoying their retirement or losing their Social Security check to a bureaucrat's mistake. And make sure you are subscribed to this channel. Why? Because next week, I am exposing a hidden clause in the new Secure 2.0 Act. It's a loophole that elite estate planners are using to completely bypass the 10-year inherited IRA rule. You absolutely do not want to miss that one if you plan on leaving a legacy. Look, retirement should be the victory lap of your life, not a legal battle against the government. Protect your wealth, check your forms, and trust no one but the exact letter of the law. I've put links to the forms we discussed, the CMS-L564 and the SSA-44 in the description below. Go download them, study them, be ready. I'm proud of you for taking the time to educate yourself today. Most people won't. Most people will just pay the penalty and wonder where their money went, but not you. I'll see you in the next one.